All successful traders manage risk well. They are aware of the risk they are exposed to and the reward when they execute a trade. This concept is known as the risk to reward. You identify how much money you could lose and evaluate it against the potential reward. The idea is simple to understand, but that doesn't mean that it is easy to do. I will show you how to filter trades like an institutional trader using the risk to reward concept in today's video. I will also show you how to manage risk better, so make sure to watch this video to the end. When it comes to understanding risk to reward, it is rather common to see traders overcomplicate it or lie to themselves. As a result, they make bad trading decisions which damage their trading account. Before I break down the aspects of risk and reward, we are currently doing a giveaway for our premium Forex signals. You have to look for an emoji in this video, and once you find that emoji, comment below emoji plus Forex signals, and you can potentially win a lifetime access to our premium Forex signals. We will announce a lucky winner in the next video, either in the video itself or in a pinned section of the comments. Make sure you subscribe and hit the notification bell so you will know when the next video comes out and whether you have won. First, let's address what the risk aspect means. For most traders, this is usually a fixed percentage of their capital. It could be anywhere from 0.5% to 3% per trade. For more advanced traders, they might implement a scoring system to allocate their money. You don't need to implement this, but it would be good to understand how institutional traders manage their risk. A higher probability setup will score higher, and thus more risk will be allocated to that trade. Conversely, a lower probability setup will score lower, and therefore less risk will be allocated to it. You might consider other risk factors such as maximum drawdown or maximum number of open positions. But no matter what factors you decide, the point here is that determining risk is usually a straightforward process. In the case of the reward aspect, things are not so straightforward. Dealing with the reward aspect is tricky because a trader can't determine the trade outcome beforehand. The market can do anything, and thus it is impossible to get an accurate idea about your profit potential for a trade. Herein lies the tricky part of determining your risk to reward ratio objectively. While it is easy to say that you enter the market with 1% risk and expect to close out the trade at a 2% reward, there is no certainty that the price will hit your target. Price might even trend strongly in your direction and cause you to leave a big chunk of money on the table. If you are curious about how we can safely assume a particular risk to reward for a trade, then keep watching because I will show you two techniques to do this. The first technique involves targeting the first support and resistance level and being conservative, assuming that price will just bounce off the first level. The underlying concept is that a level is assumed to hold unless proven otherwise. This approach is a prudent approach that assumes a conservative outcome when the market hits the first level and starts bouncing off. With this approach, it is easy to calculate your risk to reward. Let's look at an example so that you can better understand this first technique. Suppose you want to buy here with a stop loss set below the recent swing low. You identify the first resistance level over here. And because you are using this conservative approach, you will use this level to evaluate your risk to reward for this trade. This red box represents the risk of the trade, and the green box represents the potential reward. By comparing the risk and the reward, we can see that this setup has a favorable risk to reward, meaning that we can make more money than what we are risking. In this example, we see that price went on to move much higher, but that's irrelevant because we would have exited at the first resistance level using this technique. And we would never know beforehand if the market would stop at that level or go on further. There will be instances where you exited just before price reverses and other times where price just breaks the level and carry on trending. This is all part and parcel of trading. When using this technique, one of the most common problems is that targeting the first support or resistance level will not yield a good risk to reward ratio of 1:1 or better. If you find yourself facing this problem, the simple solution is to skip the trade. The market is always offering great opportunities, so there is no need to chase after trades that do not provide an asymmetrical payout. If you prefer an alternative approach that provides more flexibility and allows you to take more trades, keep watching because this second technique will let you do that. The second technique involves targeting the major support and resistance level. Depending on the setup, this could be the next immediate support or resistance area or a level past the minor support or resistance level. Let me show you an example to demonstrate how this works. In this chart, you might enter here and look to target the major resistance level over here. You also see potential minor resistance level along the way, which may prevent price from hitting your target take profit levels. Obviously, in this case, the reward is now much larger than the risk, yielding a favorable risk to reward ratio. The advantage of using this technique is that you can achieve a greater reward. However, this technique requires judgment from the trader. What constitutes a major level? That's subjective. New traders who cannot discern a major level from a minor level are likely to end up gunning for the furthest level. This is natural as a trader wants to maximize his gains. Following this technique will result in an inaccurate risk to reward that seems attractive but isn't realistic for these traders. So between the two, how do you select a technique that works for you? Well, as a general recommendation, it would be wise to stick to the first technique if you are a new trader. As you build experience and learn to discern between major and minor support and resistance, you could use the second technique to maximize your risk to reward. Another thing to consider when selecting either of the techniques is your win rate. Before you can expect your risk to reward to work for you, you must first confirm that your win rate is sufficiently high enough to justify your risk to reward. For example, if you have a risk to reward ratio of 1:1, it means that your potential profit is equal to your potential loss. This means that you only need to have a win rate slightly above 50% to make money. Suppose you take a trade with a risk to reward of 1:0.5. but you are averaging a win rate of just 50%. In this case, your win rate is not high enough to justify taking this trade. On balance, you will lose money if you take trades like this. Assuming that you risk 1% per trade and take 10 trades, you will end up with 5 losses, which is minus 5%, and 5 winners, which equates to plus 2.5%. This results in a net loss of minus 2.5%. The numbers simply do not make sense. This is why you need to consider your win rate. Now, before I end off this video, I want to address some common mistakes made by traders. Some of these mistakes are costing you a lot of money, so keep watching to evaluate if you are making these mistakes. Many traders are way too optimistic when they get into a trade, and because of their optimism, they pick a very distant take profit level, thinking that the market will go straight to this level. They might even use a very tight stop loss, thinking that price will take off immediately and that they got the perfect entry. This creates the illusion of a good risk to reward ratio. It looks good, but sadly it's just an illusion that almost never pans out. Let me explain why this is such a serious problem. Firstly, by setting a distant take profit level, price doesn't reach the level and you don't lock in your profits. The market reverses and you give back your profits. If you don't manage your trades by neutralizing your risk, a winning trade could even result in a loss. Secondly, by using a tight stop loss, the market might whip you out and trigger your stop loss before hitting your take profit level. You were right about the direction, but you didn't make a profit. Worse still, you actually lost money. Thirdly, traders use the illusion of an excellent risk to reward to reason themselves into a trade that they should not take. They bend their trading rules instead of staying objective and saying no to that trade. To avoid these issues, always ask yourself if you are setting your trade up based on the market structure. Remember that your profit targets must be realistic. You want to set your profit target ahead of the price level to reduce the likelihood of price missing your target. To sum up this video, it is crucial that you objectively identify your profit targets and not skew your risk to reward. If you are new to trading, I recommend targeting the immediate support and resistance you see. It is okay to give a trade a miss if the risk to reward is not favorable. Remember that the market offers many opportunities, so there is no need to force yourself into taking trades with low payouts. I hope you learned something useful from this video. Like this video, subscribe to the channel and comment with the emoji that you've seen plus Forex signals to enter yourself into our giveaway. The winner will be announced in the next video. So turn on the notification bell and check to see if you have won. I have also prepared a 3-day training guide which you can download via the link in the description below. Thanks for watching and I'll see you in the next video.